Welcome to the Merk Webinar. Today's topic will be on inflation and the economy. On the line, we have Merk's President and Chief Investment Officer, Axel Merk. Joining alongside Axel will be Senior Financial Analyst, Nick Reese. At the end of today's presentation, we'll have a Q&A. As always, we do encourage questions from the audience, so please feel free to ask a question at any point during the presentation by typing it into the questions box on your screen. This presentation will be recorded, and with that, I will now turn the call over to Axel to begin the presentation. Axel?
Thanks, David, and welcome, everybody. Today's webinar is a tad different. As you know, we have our topic-specific webinars, and then we have our quote-unquote quarterly webinars where we are more product-specific. Today, we've used our research service slides, and some of you are familiar with that. We cover different topics, and we'll talk more about them later in the webinar when everybody's settled in online. But basically, we've taken the slides from our inflation chart book, and Nick, our senior analyst, and I will discuss them. And as part of that, I'll also address some of the other questions that we sent out during the registration, talk about implications for the currencies and the portfolio and so forth. But as far as slides are concerned, we'll zoom in on the ones from the inflation chart book. And so I'll hand it over to Nick. He'll start most of the slides or all of the slides, and then I'll chime in if he disagrees with me. We can fight back. And by the way, we do sometimes disagree on some of these things, sometimes just in style, sometimes in substance. And then towards the end, I will talk more broadly, and then obviously in the Q&A, if you can either address a question specific to somebody or either one will answer. Anyway, with that, let's move here to the first slide, and I'll pass it over to Nick.
All right, thank you, Axel. Well, here on the first slide, this is taking an average of annualized inflation readings. So there are typically 4 inflation readings that you hear about in the news: the headline CPI rate and the core CPI rate. So the headline rate includes everything, and the core rate really excludes food and energy, which are thought to be particularly volatile components of the index. And then the other pair is the headline and core PCE, or personal consumption expenditures index readings. And the PCE index, the headline index, is technically the Fed's official inflation target. They view 2% year over year on the PCE headline index as the official Fed inflation target rate, which is part of the Fed's dual mandate, the other piece of that mandate being maximum employment. But this is just taking an average to give you a feel for the inflation rate. And a couple of things to note here is that inflation is typically relatively high and or rising going into recessions, and then tends to be declining through the course of a recession, which is somewhat consistent with the idea of a business cycle or a boom-bust cycle, where the economy goes from operating above potential GDP to operating below potential GDP. So going into these recession periods, which are marked by the bands, and one thing to note about those blue bands, which show up in a lot of the charts in general in these chart books, is that those are the official NBER recessions, and they're not known at the beginning. So where that blue band starts is the official start date or start month for the recession, but that might not be known until several months later when the NBER announces that, 9 months ago, was the peak in the business cycle, and that's when we technically entered recession. So that's something to keep in mind. But inflation was rising into recessions on these two here on the chart. And you actually did see it continuing to rise into the 2008 recession, with the oil price hitting its high of $145 a barrel in July of 2008 before declining sharply. So I'll pause there on this one.
Thanks, Nick. And let me just take a step back and elaborate on what Nick said on to the why. Why the heck are we looking at inflation in the first place? And Nick alluded to it, of course, saying, hey, inflation is rising heading into inflation, but what does it mean? What does it mean for investors? Why should you care, and so forth? several reasons. One is just recessions in general, and we don't have it on this chart book, we have it in the S&P chart book, is historically during recessions, the stock market has performed far worse than during expansions, and there are some exceptions. The most cited one is probably the 87 crash when we didn't have a recession, but a lot of the bear markets have happened during recession. So it is yet another way of saying, hey, maybe rising inflation means a recession might be coming in. And to give you a little background as to why, there are various reasons why inflation, of course, can go up, but in a quote-unquote normal business cycle, if there is such a thing, think about it, the economy is doing well. And Nick mentioned at capacity, overcapacity. Well, think about it, once there aren't enough workers left anymore, you've got to pay them more. That is quote-unquote inflationary. Profit margins get squeezed, and then because you've got to pay them more. And so that's then at the same time, the Fed tends to hike rates going into these, and that's causing then folks to the economy going back down, and the so-called soft landing that might be engineered. To me, that's more of a dream. That's a matter of luck than skill. And of course, you can trade inflation directly. There's some derivatives you can trade in the market. There's a perception that gold does well during inflation. And the reason, before we go further, the reason I just say perception is just as something to think about. When inflation ticks up, quite often, and not just in the US, the currency of a country actually strengthens, initially anyway. And the reason is that when an inflation indicator is quote-unquote above expectation, the immediate market reaction is often, well, that means the central bank, or the Fed in the case of the US, will have to tighten rates. And that's a good thing from a kind of strong currency point of view and negative for gold. It's then only in the aftermath, often several weeks later or months later, when the market comes to a realization, well, guess what? Maybe the central bank isn't all that tough, and indeed the inflationary pressures are allowed to make its way through. Back to you, Nick.
All right, thanks, Axel. Actually, a couple more comments, if you can just flip back to the previous chart, is that in terms of the relevance also is that because the Fed has this focus on the inflation target, understanding where inflation is and where it might be going is an important piece of understanding where short-term interest rates might be heading, given that the Fed controls that part of the yield curve. The other thing to note is that it's not, even though it's getting quite a bit of attention right now that we're kind of back above this 2%, dotted line here, it's not the first time that we've been above it in this expansion. You can see it's either been touched or exceeded 3 times, prior to this current uptick. And some of those prior upticks, as well as this current uptick, are related to base effects, which I want to talk about in the next slide. So what are meant by base effects is pretty simple, just kind of mathematical concept that the readings, when they come out, when you see the inflation readings come out on a monthly basis, and there are really 2 numbers that are reported month over month and year over year. And when you have a kink in these, like a downward tick or a kink in the index, and let me just mention that these are the overall indexes, which are actually instead of the month over month or year over year rate of change, this is the index that's actually underlying those readings. And so when you get into a year past this flattish period that we had in the first half of 2017, or you can see that downtick in the first quarter of 2017, that's going to create a year over year, kind of just mathematical effect of having an uptick on the reading. And that's already being experienced right now with the readings and should continue through this summer. So people shouldn't be surprised to see this uptick in inflation. It isn't necessarily indicative of some kind of overall rising inflation pressure. It certainly, it could be, but it's certainly in part based on just this base effect concept.
And by the way,
Axel, maybe you can clarify that.
Yeah, well, the FOMC minutes today that were released mentioned that inflation might temporarily go above the 2% target. Might not have the wording exactly right how the FOMC minutes stated it, but it may well allude to something like this, that just statistically speaking, the next several months will show higher inflation readings than the 2% target. And with that, they want to take the fear out of the market that the Fed is going to be extremely hawkish. Now, the way that the market read it, though, is that, they're going to tighten less. And so who knows whether that's robots reading those minutes or whatever it is, it may not be that the Fed changed course here. It's just they want to clarify and kind of be ahead of the game and telling the market, hey, listen, guys, just don't take the readings in the coming months too seriously.
So with respect to following base effects, one of the things, and those previous two indexes on the last slide were the headline indexes, in other words, not taking out food and energy prices. And so part of the reason for the base effects is the year-over-year change in the oil price. And this chart just shows the cumulative percentage change in the oil price over the past year. And so you can see there was a dip down in June of last year when the oil price, bottomed. And so for June of this year, assuming that oil prices remain elevated, right now we're around $72 a barrel. If they remain elevated or even continue to trend a little bit higher, we should get some base effects when the June 2018 reading comes out, just given the downtick from June 2017.
And just something to keep in mind, when we talk about inflation and inflation rate, the Fed is kind of interested in two things. One is, often they say, hey, things are transitory. And then it means, well, if the year-over-year inflation may be high due to oil, due to something else, but they're really concerned about, well, is there a ripple-through effect? The Europeans talk about second-round effects. That is it going to affect other things and going to create persistently higher prices? But if you're just plateauing out at a higher level, then they'll say, hey, a year later we have zero inflation, right? Even though you're now at a higher price level. Nick?
All right, so this chart shows a market-based inflation expectation metric, which is the black line. That's the 5-year forward CPI annualized inflation expectation, and that's a directly tradable financial instrument. You can see that tends to show a relationship to the level of oil. So the oil price is in gray there. And so as oil fell in 2014, inflation expectations, the forward-looking inflation expectations declined. And similarly, over the past couple of years, and especially over the past, year or so, we've seen this rise in the oil price and this commensurate rise in the inflation expectations. And to some extent, that might make sense on the basis that regarding the concept of cost push inflation, that basically energy, which is an input into the production process, as producers face higher energy costs to produce their output, those higher costs are going to be passed on to consumers. But oil is also a direct consumer good as well. And what I've seen when I've looked at it is that actually there's not much lag between increases in oil prices and the current CPI readings. And so to me, it's sort of an interesting relationship that the forward-looking inflation expectations rise with the higher current oil price, because in my mind, it seems like the higher the oil price, the greater the potential that you're going to actually create negative base effects going forward, with the potential for mean reversion in the oil price. So that's just something to keep an eye on, is this inflation expectation metric, which is nice because it's directly tradable in the market. So that's a good one to look at. But it's also interesting to see this relationship to oil, and I'm not sure that totally makes that the market's totally right to be pricing it that way.
So before you guys try to quote unquote trade this in the market, this is an over-the-counter product. You need to go to kind of a bank to do it. But these things are traded, and Bloomberg does quote these things. There are various ways to look at inflation expectations. You can also take the difference between the nominal rates and the tips, for example, and calculate it that way. But the point is, any of these things, when short-term inflationary pressures go up, for example, through the price of oil, often expectations for longer-term inflation often also rise with that in tandem. And that sometimes makes sense and sometimes might be a tad of an overstatement. I'd just like to remind people, kind of in recent months, we've had inflation expectations, or at least rate hike expectations go up substantially, and then often they react very, very sensitively to very short-term data. Anyway, back to you, Nick.
Yeah, that's an important point, that part of the reason why inflation expectations are important is that they factor into the Fed's thinking about how quickly they might need to raise rates, and it's also something that gets factored into the longer end of the yield curve, where these rates on the 10-year Treasury or 30-year Treasury should incorporate some kind of inflation premium. All right, so looking at the chart here, the black line is the employment cost index, which is thought to be, many economists think that this is a very good and metric for looking at labor costs, and better than the average hourly earnings that gets focused on in the monthly jobs report. And then the gray line here is the Small Business Compensation Plans Index, which is a survey-based measure. And one thing to note, and this concept will come up in coming slides, is that that gray indicator is shifted forward on the x-axis to show the potential fit as a leading indicator. So that, as that has been continuing to rise, that suggests that the employment cost index very well may continue to rise as well. And this ties into the concept that I mentioned on the previous chart about cost push inflation, where if producers, companies are experiencing higher labor costs, those costs could be passed on to consumers in the future.
So just to emphasize that, and that the x-axis for the gray line on this and some of the other charts has been shifted, and it's to do a little bit of curve fitting here, to suggest that these trends might be correlated. And I say suggest because one can always argue these things, whether one just takes the sample set you have in front of you or not. But there tends to be a kind of a fundamental reason why these things might arguably be this way. And clearly, when you have these sort of cost index measures, there's presumably some sort of relationship. I'll comment more on the next slide here to kind of talk about the more broader point about the labor market and inflation. Nick, do you want to start with this?
Yeah, sure. And this chart is also shown in the chart book that focuses on the Federal Reserve, because it relates to one of the concepts that they talk about a lot, which is called the Phillips curve. And basically that's just the idea that there is a relationship between the unemployment rate and the rate of wage inflation. The theory there being that as the unemployment rate comes down, there's more pressure on wages. Wages should be moving up. And you can see that in the prior two cycles, there's a pretty good kind of mirror image here of the unemployment rate coming down and inflation, wage inflation rising. And this has been somewhat missing in this cycle, and it's been one of the things that Fed officials and economists have been somewhat puzzled about, as to why there has not been more wage inflation given how much the unemployment rate has come down. In the prior cycles, when the unemployment rate was close to this level, the wage inflation rate was around 4%, and we're still down at 2.6%. But many are thinking that we're getting to this point where we are going to see some of this Phillips curve effect, where a continually falling unemployment rate is going to add to wage pressures. And this relates to the general idea that Axel was talking about a second ago, about remaining slack in the economy. If you're running out of the pool of potential workers that you can hire, there's this idea that there will tend to be more competition to hire, and therefore a bidding up of wages.
So this chart is one that gets talked about a lot, maybe not exactly this specific one, but this concept, right? Unemployment rate is falling. We are at below 4% on the unemployment rate. And have we not seen inflation yet, right? That's a common question. And that really depends on who you ask and so forth. One of the reasons why we are looking at these charts here and discussing them with you. But there are several people that say, hey, look at some of the wage components. They have been rising. And they'll continue to kind of rise and accelerate as we go down. And I do believe we have some charts as well on the discouraged workers and how they're coming back in the labor force. And Nick, correct me if we don't have that. But the idea is that we have a lot of people on the sidelines, and because they've had disability benefits or some other reason not to be in the workforce, and as the labor market's tighter, incentives, presumably through higher wages, increase to get them into the workforce. But at some point, that pool is also going to be exhausted. And so the current thinking at the Fed is that, yep, there's enough slack. our thinking, if I can put words to your next mouth a little bit, is that we have several months left in that, but we will exhaust that at some point, maybe late this year, maybe early next year, and then those pressures are going to get stronger, because based on kind of just looking at some trend lines with their comparison, odds are that at that stage we'll see some more serious wage pressures. But at this stage, they've been shrugged off, and the Fed has continued to downplay those sort of fears.
Yeah, I think there are a number of indicators that suggest that we're very close to full employment, if not at full employment, but there are still a few indicators that suggest some remaining slack, and Powell, the chair of the Fed, has been highlighting those. And so yeah, I think it's fair to say that we're close, but perhaps not quite there. And the chart that I think you're referencing, actually, we don't have in this chart book, but it's the chart that shows basically the millions of Americans on disability, and that's been trending down, presumably in large part because some of those workers have been coming off of the disability rolls and back into the labor force, which is a very encouraging sign to see. But at some point, presumably that would level off, and that would be, I think, a very strong indicator that the slack has been exhausted. All right, so on the chart here on the screen, this is the capacity utilization rate and the inflation rate. And again, there's a shift here on the x-axis. So the capacity utilization rate is led by 15 months to show the potential fit as a leading indicator. And this relates to the same concept as slack, as we've talked about it with respect to the labor market. But capacity utilization refers to the installed fixed capital in the country. And so if you think about bakeries or factories, if those things were cranking out product at 24/7, you'd be at 100% capacity utilization. But in any case, as you see that trend higher, that does seem to correspond somewhat to inflationary pressure. And so as capacity utilization has been rising, we would expect, at least I would expect based on this framework, to see some inflationary pressure. Now, obviously, we've already, if you look at this chart, we've already seen a bit of a jump up here on the core CPI year-over-year rate. And in part, that may be related to base effects, but in any of these inflation readings, there are going to be multiple variables and cross currents that are influencing it. This would just be one that we cross-reference as well.
And just another word on slack, the basic question for anybody at the Fed is, at what stage do you act, right? You can say, all right, let's assume for a moment that on December 31st this year, this slack is going to be exhausted. First of all, we don't know that. The Fed doesn't know that. But even if you did know, well, you start hiking rates now a little bit more aggressively, because once you reach the full capacity, the pressures are going to be too severe. Or do you say, hey, what the heck, inflation isn't really a problem, let it go up a little bit, and then, yeah, we'll manage it when it comes out. And that's then where the different personalities come in the Fed. They have different views and so forth. They're all committed to keeping inflation in check, but they have different ideas of how to go about it, and have different frameworks how to think about actually managing that.
All right, then looking at the real GDP year over year, similar concept here. This is led by 18 months. And the potential reason as to why this might be the case is, I guess, tying back to the comment on the first chart, which is that as the business cycle continues and the economy grows, you potentially get to a point where you are operating at and then above the potential GDP and running out of slack in the economy. So there seems to be somewhat of a fit here. Don't want to overinterpret it, but it's just another data point, another indicator that we track.
And then I see on the bottom of this chart, you see this line analysis column. Might be a good time to just mention it. Since December last year, we've been publishing what we call as a research service. And we haven't sent it to everybody, only those who've been engaging in certain things, because it's still it's a project. And so for this chart set, we produce a chart set, and we have a chart set, and then we produce a video. This video that we produced with this one is annotated. Some of them are just quote-unquote music. And of course, now we do a webinar to go more in depth. And so we very much welcome feedback on what format you like the best and so forth. And as far as this webinar is concerned, by all means, please submit questions in the Q&A box, and we'll try to get to them at the end.
All right, then this really just ties on to the previous chart. This is the U.S. manufacturing PMI, and here it's a longer lead. It's led by 24 months, and that's consistent with the idea that this U.S. manufacturing PMI is in and of itself a leading indicator of economic growth. And so here you've got a potentially two-year leading indicator that is suggesting inflationary pressure over the coming year and a half or so at least, and that is consistent with the time frame on the following chart. But let me pause there on this
yes,
one.
and just again as a caution, like we offset here these x-axes to make the curve fit, and say this is just one way to suggest this. Yeah, inflation is going to shoot higher based on the PMI. Other charts might disagree, and it's one of the reasons why we go through these charts to kind of look at different ways and trying to get away from the kind of just saying, oh, this is, so for example, today in the FOMC minutes, to reiterate that, there was a statement in there that, oh, let inflation overshoot a little bit, we don't worry. Well, do you panic, right? Because inflation is going to go and the Fed is not going to care about it? Or do you try to put it into context? And in some ways, it's a little dry to look at these charts. And at the other end of the spectrum, though, unless one actually does do the homework, you can't really make up your mind. And you can, of course, argue, hey, yeah, let somebody else do the homework and just give me the summary. We hope that our audience here is sufficiently interested to go into this. And by all means, tell us if we bore you and should move through these faster. But other than that, we'll continue here, showing you a little bit more in depth these inflation charts. Nick?
Yeah, so this chart is now relating the idea that demographics might be an influence on inflation, and it's very curious to me, this potential fit. Let me explain what we're looking at here. So the gray line is the active labor force, 15 to 24 years old, led by 7.5 years. So you're effectively looking at the labor force that's kind of mid-20s to early 30s, the year-over-year rate of change of that, and then mapped against the year-over-year rate of change of core PCE. And now this could be a purely coincidental fit here, and of course our eyes can play tricks on us, but basically the potential logic, and this is, you know, fairly speculative, but the rough idea would be something like these mid-20s to early 30s members of the labor force, or members of the population more generally, are in their peak kind of borrowing and spending years. It's around the time in their life when they would be taking out first mortgages, engaging in household formation, having babies, spending on newborns, and that borrowing and spending might provide an inflationary impetus. I'll talk a little bit more about that on the next chart, but basically the echo boom generation that's now in this time in their lives is relatively large. The largest birth year for that generation is 1990, so they're turning 28 years old this year, which is kind of right in the sweet spot for that behavior at that time in their life.
So as Nick indicated, we have 2 more slides on inflation, and we'll talk more about the controversy, of course, of using demographics and inflation on those slides. Just on reiterating or rephrasing what Nick said, is that when people are under prime spending years, the demand to take out loans, the demand for credit should go up, and because of that, interest rates go higher, right? And so that argument then suggests, well, when you have a lot of people in the prime spending years, rates are higher, and when you have a lot of people retiring, they have less demand for credit, you have some deflationary pressures. And so that's this big argument about deflationary pressures as a society is aging. And what this chart shows that if you believe in that argument, and I'm putting out an if, and I'll explain later why I put out that if, then for the next 18 months or so, and I don't know whether you can see the mouse that I'm moving here on this, you might actually have an uptick due to inflation. if you believe the curve fitting of this chart. And the reason we use this odd age group here is because that's available from the census, and then we shift that thing forward to project out. And so just food for thought, if you do believe in demographics, I would put that argument on pause as a deflationary indicator, even twist it around as a potential inflationary tailwind for the next several months.
Yeah. So, well, just a couple more comments actually on that previous chart. Yeah, this does seem to correspond somewhat to the previous PMI chart, that we could see some inflationary pressures through the end of next year or early into 2020. And then the other thing to mention is that, well, I'll be very interested to see how this develops. But I set the chart up last fall when the core PCE year over year was 1.3. So far it has actually seemed to follow this gray indicator. So it'll be very interesting to see how that develops going forward.
And by the way, many of these slides suggest that inflation might be a tad higher than previously maybe anticipated by some people. And I'd like to just point out, many people are not aware of that. Last year was the first year in many that the Fed actually hiked rates more than was priced in the beginning of that year. And we think that may very well happen again this year. And we can talk about kind of Fed tightening here more in a moment, but for the moment, let's stick here with demographics and Nick here.
Yeah. So let me talk a little bit about the idea of demographic analysis in general, and I think this chart is a good one to illustrate it. This is the live births, millions per year in the U.S. going back to 1905. And I've got these rough brackets, these years groupings for the generations. There's some debate about where exactly you would draw the dividing years, but this grouping is nice because each grouping is 17 calendar years. And one thing that's worth noting is how stark the difference in sizes between the baby boom generation and the prior silent generation. Now, the reason why the silent generation might have been a little bit lower than even the previous GI generation could have something to do with the Great Depression. But in any case, you can see this baby boom generation. I've got the years 1947 to 1963. The total live births there, 68.4 million. That compares to the previous generation, the silent generation, 44.9. So that's a really big difference, a difference of more than 20 million people more in the baby boomer generation. And I think that as the baby boomers moved into that period that we just talked about, their kind of peak borrowing and spending years, their family formation years, there was a tremendous demand for credit that could not be filled by presumably who would be the net savers, the silent generation before them. And I think that was a large contributor to the high both real interest rates and inflation rates. Those two together equal nominal rates of the 1960s and 1970s. And we'll cover that a little bit more in the next slide.
I'll have you talk about the next slide before I chime in and comment on the concept as a whole. Go ahead.
Sure. So here is the in black is the CPI year over year 10-year moving average. And the gray line is the 16 to 20-year-olds as a percent of the labor force, and that's led by 7.5 years. And you can see there seems to be arguably somewhat of a relationship there. And again, it could be purely coincidental. There are a range of views as to whether demographics should or should not be a factor. To me, there's some potential logic to it. And I think that some of the analysis that not just I look at, but others look at, does seem to be certainly worth seriously considering. But in any case, you see here the rise in the young people entering the labor force, coinciding with that rise, that kind of trend rate of inflation. Now, obviously, there are specific things happening, and I'm not saying that this is the single factor that's affecting inflation. Of course not, but it certainly seems to be a potential factor that's contributing to this period of rising inflation in the 60s and 70s. And then because that is shifted forward, it gives us a little bit of a window into the future as to what the demographics are going to look like over the next, let's say, 10 years. I mean, you can go out 10, 20 years with demographics, and that's one of the things that's nice about it, is that once people are born, it's just a matter of the passage of time. People who are 28 this year are going to be 29 next year, and so on. And so unlike so many things that we look at and talk about in finance and economics, this is actually something that you can have a relatively high degree of certainty about. And in any case, that suggests that there, from a demographic standpoint, should not be really much inflationary pressure kind of looking out over the next 10 years. Axel?
So yeah, let's talk a little bit about the quote unquote controversy of using demographics. As many of you are aware, we work with Bill Poole, the former president of the St. Louis Federal Reserve, and every other week we have what we call our economic strategy sessions. And by the way, if any of you have an interest in ever participating in one of those, listening in or asking questions, drop a note and we'll think about whether we should at some point open it up to others on an invitation basis. But in any case, one of the things that came up in the context of demographics is, of course, well, the 1970s inflation, is that due to demographics, or is that due to quote unquote bad monetary policy that came into play? And somebody, a former policymaker, he obviously might think that monetary policy might have had something to do with it, in particular bad monetary policy. And he didn't say that, but I might add, well, if monetary policy didn't matter, we wouldn't need to have central bankers setting monetary policy. And if you know already 20 years out what to do and so forth. But the argument as to why demographics at least may have been a significant contributing factor is because of what Nick has pointed out, is that this huge surge in potential increased demand for credit. Now, the arguments against it is that maybe the monetary policy was bad and inappropriate and volatile during that year. And by the way, it was also then Volcker who broke the neck of inflation by changing monetary policy. And then Bill mentioned several examples from history that where we had an increase in the labor force, which is very closely related to kind of this sort of demographic trend, and said that, well, there was a large increase in the labor force in World War II and some inflation, and then the women left labor force starting in 45, as did many GIs when they went back to college, and then inflation started to surge in 45 to 38, and again in 1950 when the Korean War broke out. And so now we didn't have the current framework of conducting monetary policy. We used a gold standard and then some sort of weakened form of it. But the jury is very much still out. And so the reason why all of that is relevant is because if you look at something like Japan, people say, well, they'll never have inflation despite the huge GDP because of those very negative demographic trends. And of course, there's also some countries that have spent too much, have seen huge inflation, but the US has a special privilege that almost all the debt the US has is US dollar denominated, and so they're less dependent to outside shocks and so forth. And so the debate on this is open. Now that said, very few people are disputing that in general, of course, that an aging society has less demand for credit, but when you have then other folks jump in, like the government, that spend a great deal, or when you have entitlement spending that is supposed to be ramped up substantially, well, the question is, how does this play out? And there are many theories about it, because obviously nobody has a crystal ball, but I've made the argument, and some others have, is we've made too many promises, so we've got to address them somehow. And meaning inflation is one way we can, quote unquote, pay for entitlements, or at least try to. We can cut the benefits. That means default on the benefits in some indirect or direct way. And so this particular argument seems to suggest that, we don't need to worry about inflation too much. But I would argue that the jury's out. Do you want to comment on that, or should we go to the next slide?
No, we can go to the next slide.
Go ahead.
All right, so this is the Citi U.S. Inflation Surprise Index, and basically, well, Citibank constructs it, but the idea is that it's measuring inflation surprises relative to consensus market expectations. And so anything above 0, which would be green, is inflation readings that are coming out above expectations, and then anything that's red would be coming out below expectations. And one thing is that, and this is kind of similar to the first chart, you can see that the inflation was not only high going into these recessions, but actually above expectations. And I think that that's not too much of a surprise in the sense that inflation really, at least in my view, is somewhat of a break to business and consumer conditions, especially unexpected inflation. If you're a consumer and you have a planned spending pattern based on what you earn, and businesses are engaging in projects based on estimates of how much the inputs are going to cost them, and it turns out that those estimates are incorrect, and in fact things are more expensive than they thought they were going to be, that's going to naturally be a sort of a tightening of real economic conditions. It's also, because of the Fed's framework and mandate, it's also at the time when the Fed is going to be tightening financial conditions because inflation looks like it's now a real problem. It's probably above target and coming out higher than expected. And so that combination of tightening real world conditions because of inflation and higher than expected inflation and tightening financial conditions, it's not too surprising that that is followed by a recession. And so one thing that I'm looking for here that relates to the business cycle is to see inflation readings coming out, continually above target, which would be kind of referencing the first chart that we looked at, but also coming out higher than expected. And I think some of the indicators that we've looked at suggest that we could get into that environment where I wouldn't be surprised over the next, let's say 18 to 24 months if we see inflation readings in the kind of upper part of the 2 to 3% range, so mid 2% to close to 3%, and that could have implications for Fed policy and for the business cycle generally.
All right, before we go to Q&A, let me make some broader comments. And I had indicated when we sent out the webinar invite, we'll talk about some other currencies as well and for portfolio implications. So let me expand on that before we go to the Q&A. In the meantime, if you have questions, please submit them. We've got already several. So in the beginning, I kind of asked the question, well, why do we care about any of this? And obviously, inflation drives asset prices in some ways, and it drives Fed policy most notably. And inflation has different trends in different stages of the economy. Inflation tends to pick up just ahead of a recession. And so you can make bets in the market on higher inflation. And I indicated also that when inflation expectations rise, that's often a quote-unquote good thing for the currency, at least in the short term, as perverse as it sounds, because there's the expectation of a central bank doing the quote-unquote right thing, and one only knows with some delay of what's going to happen in practice. And the U.S. is clearly ahead of the game versus other major economies as far as its economic cycle is concerned. While the economy in Germany may be booming, inflationary pressures there are more subdued. Home prices there have gone up, but in other areas of the Eurozone economy, it's been sluggish. Although we don't have the charts here for the Eurozone, inflation expectations has also been moving up. They've actually been moving up quite steadily. And in the short term, of course, other things are then affecting market prices. As you undoubtedly have heard, Italy is just, I hope that you can still see the screen. I just got I got a different window here for a second. So there are curveballs that are thrown into the markets, and of course, if they do force disruptions, they inhibit business, and then that will affect inflation expectations as well. To just talk about real currencies, one of the questions that was pre-submitted is that why is the price of gold so closely correlated to the yen? And that relationship, by the way, is not always there. But if you think about it, the gold is an asset that's it's a brick. It doesn't pay a dividend. It just is. And the yen, well, if you look at interest rates across the yield curve on the yen, it's pretty flat. And notably, at the 10-year, you get close to zero in interest. And so if you get close to zero in interest on the 10-year and on the JGBs, on the Japanese government bonds, and sure, if you hold gold for 10 years, you also get close to zero, right? And so there is a similarity, and that's regardless of the fact that, of course, in Japan you have policies, you might have a change in government or at least a prime minister there, other things, and of course these things don't move in lockstep, but one often has it that these things move together because they're both very low interest rate currencies, if one can call them such, right? Zero for gold, for that matter. And of course, you've got negative interest rates in the Eurozone and whatnot. If you look at inflation expectations in the UK, for example, they have been significantly higher, and a lot of that goes back to the quote-unquote base effects that Nick talked about, with the shock of the Brexit vote and some significant adjustments there. But the sterling is driven by many more things. I have argued that in the medium term, the Brits are going to have a difficult time with the budget, and they're going to provide substantial stimulus to the economy, and they're going to have higher inflation going forward. But again, it doesn't mean that the sterling is always going to be that quote-unquote weak currency. Going back to the dollar, we had 4 years of the dollar rising. Then the dollar fell for a year and a half, and I'm rounding here. And now in recent months, the dollar has been strengthening, and quite significantly so of late versus the euro. The euro was at 124 not long ago, and now it's at 117. And so the question is, well, what has changed? And one of the things that has changed is that the Fed currently seems to be very fine in hiking rates. And the reason the Fed is fine in hiking rates is that we're in a very different environment from early 2016. In early 2016, when the Fed, when the market had a hiccup, you might recall it was the issues in fracking, that access to credit for the oil sector in particular is getting tighter. And there was a risk or a good chance we could have fallen into recession. Well, we didn't. And recovered from that. And ever since then, the market has been quite nice. We had a little threat here of the short roll trade blowing up earlier this year. But what hasn't happened since early 2016, we haven't had these so-called financial conditions deteriorate, meaning access to credit has been just fine. In fact, some banks have eased lending standards. Some sectors of the economy have had a tighter credit market, in particular the lower end of the corporate credits, and part of that may well be because the government is issuing so much debt. And so if you're a corporate issuer, you're competing with that. The junk bond issuers haven't had a problem because it's a different segment of the market. And so there are these little things that affect the market in the short term. But and the Fed has indicated, oh, we are not trying to tighten. That's yes, I would say, because the whole point of hiking rates is to tighten, but it hasn't happened. But it is something that's very natural, that's very common to happen. As an economy heats up, lending standards tend to get easier because the banks want to participate in that, right? They see that their competitors write all these loans, so they want to jump in and dance with the crowd. And it's in that sort of environment that inflation picks up. And so if you are concerned about inflation, well, these charts speak for themselves. My take would be in the coming months, inflationary pressures, just statistically speaking, just because of the base effect, inflation is going to pick up. But then also these other pressures are going to move in there, and the Fed is going to continue to march higher until there is some significant headwind due to financial conditions deteriorate. And the longer they have to march, and the longer financial conditions remain, quote unquote, just fine, well, the happier they will be to move on. And at this stage, the market has shrugged everything off. Now, at the same time, volatility is increasing in the markets. And then if you go back to something like gold, one of the reasons I like gold, even in a rising rate environment, is because as rates rise, volatility should rise. And because you're discounting future cash flows more, that means you're paying more emphasis to the shorter term. Well, gold doesn't have a cash flow. And so in that context, an asset that doesn't pay interest is actually something that can do quite well in a rising interest rate environment. But even the price of gold is going to be more volatile in that sort of environment. And so in the meantime, if you look at the average portfolio, to talk just about portfolio construction in a second, I have alleged that a lot of people have not taken chips off the table. They're exposed to a lot of risk assets. When they have diversified to bonds, in my view, they have also been chasing yield, which means they have a portfolio that's quite significantly exposed to risk assets. And as volatility moves higher, they're going to be headwinds. Now, of course, if we have a tax reform and earnings go through the roof, maybe those equity prices are justified. And this is not a webinar on equities. We do have a chart set here on equities that give a little bit of flavor on that, and then we'll publish more on that. But I do think as this process evolves, people are going to try to look more for ways to take chips off the table, and cash may be a good way to do that. As far as the dollar is concerned, we've had quite a rise of late. We've had a lot of negative news now priced in because of Italy, and let me just take that question up front because of that new government. This new government in Italy has two populist parties that are at different ends of the political spectrum. Now, maybe you cannot apply the traditional ways of classifying parties with left and right as much, but they don't like each other so much. And there is an election coming up in the European Parliament next year, so they'll be rivals, so they have to show that they differentiate themselves. That also means that's the reason why they've put up this technocrat as a prime minister. And the one thing to also keep in mind, the president of Italy is allowed to veto laws that the president deems unconstitutional. And one constitutional amendment that was made in the peak of the credit crisis was that that throughout a budgetary cycle, there has to be fiscal discipline in Italy. And so the president can push back on some of the initiatives that Italy has. Now, that said, we've seen it with other populist governments, including the one yours truly at home. You can keep the quote-unquote establishment of Kiel quite easily. And so there are going to be headlines coming out. And if you look at the euro, for example, it's been trading very much in lockstep with Italian bonds in the last couple of days. Lockstep might be an overstatement, but there has been some significant correlation there. And so at least in the short term, the market is mesmerized with what's happening in Italy. Anyway, move a little bit here beyond. Let me pass it here to David to manage the Q&A. David.
Great, thanks, Axel. So we do have the disclosure page up. Just please take a second to read over this while we move to the Q&A portion of the call. So our first question comes from Byron and an extension to the Italy question. Are emerging markets growth slowing down? Axel?
Well, sure, yes. I mean, emerging markets have been in the news quite a bit of late. And what a lot of people have pointed out that emerging markets are a very, very differentiated picture these days. You have a great different economies. Some of the emerging markets have undergone substantial reform in recent years, and others are very much, the key challenge is that a lot of the funding in emerging market comes in US dollars because it's cheaper. Rates in the US are cheaper. And so then when rates go up in the US, well, they tend to scramble. And I attended a conference at the Hoover Institute 2 weeks ago, I think it was. And one of the commentators that said is that one of the reasons why emerging markets continue to do that, even though they know that it's precarious when the market swings in the US, is because of a weak legal system. And the way to think about it is that corporate borrowers might not be held accountable when they default on their debt. And so there seems to be this implicit incentive. Yeah, get the cheap credit while you can, because if things go wrong, you get away with it. And so I haven't fully wrapped my head around that, but that's an interesting thought. But Nick, maybe you want to chime in if you want to talk about any specific country or not. Let me know, Nick.
No, nothing to add on my end.
All right. Yeah, to just mention a little bit here, Turkey has been in news quite a bit. Turkey, the reason why the Turkish lira has been under tremendous pressure of late, today it's up 2.5% or 2.2% right now, just tick down again, is because the Erdogan had said that he doesn't like rates as high. It's only those foreign capitalists or so that benefit from that. And by the way, after the election, he's going to have a firmer grip on the central bank and coerce lower rates. Well, if you pick a battle with the markets, it's usually not a good idea, because that means if a central bank is not independent, it means it cannot have inflation targeting as its guideline. And when that's the case, well, the suspicion is that a central bank, a government is going to use the central bank to spend more money. And that's usually inflationary. And so that's when inflation expectations get unanchored, when currencies go into a free fall, when things turn bad. And so this is very much a homegrown problem. Now, at the same time, today, Turkey raised rates. And so with that, you get a short squeeze, you get things move higher. And the currency has gone down substantially. Now, that said, the external debt of Turkey, or the total indebtedness of Turkey, is comparatively low. The economy is actually not doing so poorly. So it is all a confidence game. Different from Argentina, where, well, they kind of lost sight of their independence a little bit, and inflation pushed higher. And when you do that, it is just all the more difficult to try to clamp down. But there are some other countries that are completely in a different world and react very, very differently. Now, ultimately, this world is interconnected. Ultimately, when the US sneezes, the rest of the world catches a cold, and the same can be said about China these days. If China were to have a downturn, then a lot of people are supplying to China these days, and that gets re-exported to an extent to the US. But yes, the problem starts somewhere and then tends to spread. The one thing I might want to mention, just because it's a related topic, is there's a lot of talk about trade issues. And when the trade tensions between the US and NAFTA first flared up, those currencies weakened. And since then, they have mostly recovered. When a country like Mexico is hugely dependent on exporting to the US, then yes, trade tensions are weak for the currency that might be kind of shunned from trading with the US. But if trade tensions happen with a country where there's a current account deficit, the main thing you do is you are eliminating an avenue to finance the deficit. And that doesn't mean the deficit won't be financed anymore, but it might be through a different channel. It might require higher rates. But also, historically, when both Japan and the Eurozone are in that camp, when there's less trade, when there's an economic shock, those currencies don't necessarily go down. The yen is famous for often moving higher the worse the economy is doing there. And so if you were to improve sanctions, that doesn't, to Japan, that doesn't mean the yen goes down. Because the reason is that the economic slowdown means people are saving more, and everything else equal, that's a positive for the currency. And so there are many other dynamics here that are play on how these things that play out in real life. Back to you, David.
Okay, so our next question comes from Mike, and the question is, does QE, quantitative easing, or the need to unwind QE have any effect here in terms of inflation? Axel?
That's a good question. Nick, do you want to have a first stab at that?
Yes, I think that that the important thing to understand about QE operationally is that these asset purchases are basically taking treasuries and mortgage-backed securities out of the private sector and replacing it with cash, and that cash, which has been earmarked for financial assets, is then deployed to close substitutes. And so I think that QE and quantitative tightening now is going to be more impactful with respect to what you could call asset price inflation, or just financial asset prices, rather than consumer price inflation. The QE had very little effect on consumer price inflation.
So, and by the way, one of the things, of course, the reason QE was started is because tremendous deflationary forces were at play. And so you could argue it was inflationary in that sense, that it prevented a deflationary spiral. What it does, I mean, Nick is technically very correct. And the one thing I would like to add is that you're providing, by replacing the treasuries or mortgage-backed securities with cash, you're allowing the banks to lend more. Now, obviously, what needs to happen is there needs to be demand for credit in order to create that inflation. And so one of the reasons why central banks raise rates or engage in quantitative tightening, if one wants to look at that, is because the banks have started to lend, and they've started to lend to an extent that the Fed thinks that, oh, we got to take this back a little bit, because one of the things that the banks are suddenly sitting on this pool of cash, and some people are saying, oh my God, that's a powder keg that could explode. And some people are saying, oh, don't you worry about it. And part of the reason why some people say don't worry about it is because, hey, the Fed can always raise interest on reserves, meaning they can make it more attractive for a bank to put the money on deposit at the Fed rather than to lend it out. So they have new tools to do it. That said, a lot of these mechanisms are untested, and a lot of people are concerned that this may play out in a variety of ways. But yes, headline inflation or consumer inflation was limited in recent years. That is correct. Asset inflation was very significant. Now, obviously, if we have asset inflation, the question is, will QT, quantitative tightening, be a headwind to asset prices? And nobody really knows, but we do know that the Fed was very concerned about it, because otherwise we wouldn't have had this dance about Yellen talking about, oh, quantitative tightening is like watching paint dry on the wall and it doesn't really matter and it's not really tightening. This was all having kind of 2016, early 2016 in the back of the Fed's head, that they just don't want to rock the boat, because they know that this you cannot take for granted that this is going to be smooth sailing. Now, the markets have been behaving. We've had a fiscal stimulus, by the way, on top of that. And so that all makes it easier for the Fed to tighten without disrupting everything. But at the same time, of course, some other parts of the world, we have some issues flare up as the Fed is doing what it's supposed to be doing with regard to the U.S. economy. Back to you, David.
Great. And our last question comes from Paul. And the question is, interested in how current inflation trajectory compares to the 1970s. Axel?
Well, obviously, inflation trajectory is at this stage much lower, right? And on backdrop that Nick had pointed out here, what I emphasized as well, is demographic trends are different. We had a very volatile Fed policy. Now we have a super careful one. The question is, we start having things that relate to the 70s. We have the talk about tariffs and quotas, price controls. Maybe I'm jumping here to conclusions, but some of what's happening could be interpreted as such. But we just had a headline as I started this webinar about some potential import tariffs on cars. I haven't read the details on that, but there are all kinds of things that could create some sort of challenges. The real question is that as inflation marches higher, how is the Fed going to react? And any Fed official will tell you they'll do the right thing. And they'll also, but many of them say, hey, if and when inflation does pick up, we know that's a tool we know how to fight. The question then really is that how much are they willing to put an economy into recession to fight inflation? So let's just take the scenario that we have this wage pressure building. People have been coming in from the sidelines, and in a few months, that will be exhausted, and wage pressures will show up in earnest at a much higher rate than they have in the past. Well, Fed policy acts with a lag, with a significant lag. And has the Fed been, quote unquote, behind the curve? There are lots of people that argue, no, they haven't. Others say, oh, they'd be cautious. And the one thing here, we haven't talked about the psychology much. We have Powell as the Fed chair now, who's a lawyer. He is not a PhD economist. He doesn't have his quote framework how to think about these things, but he's a smart guy. And so my take on that is he's call a committee to study it and listen to the quote-unquote experts at the Fed to make up his mind. And the emphasis is that this is going to take some time. And so in my reading of Powell, and that's just my speculative reading, is he is going to be late. And it's one of the reasons why I don't think that gold is a bad investment in this sort of environment. Investors might want to look at that as a diversifier. It is because I think that's institutionally the Fed is going to be inhibited from moving too fast. And so with that, the inflationary pressures can continue to build. Are we going to have the sort of inflation we had in the 70s? Right now, there seems to be no sign that that's going to be the case. But at the same time, the glass has been half full for a very, very long time. And so if people are a little bit concerned and want to take chips off the table, I don't blame them. So let me close by just saying again, we have at Merk Investments, we've got a kind of this button for Merk Research where you can get a PDF stack of these slides. Feel free to download those and give us feedback on what format you like of these slides. Be very interested in what you like and don't like. If you have a question for an upcoming webinar or a topic we'd like to cover, let us know. Was this too dry? Was this of interest? Should we be more market-oriented, more cartoons and fewer charts, or more charts and keep the cartoons out, let us know. All right, back to you, David.
Great, thank you, Axel. Great questions today, and that concludes the Q&A portion of the call. And if we were not able to get to your question today, we will get back to you via email. If you have any additional questions or comments and would like a copy of the presentation slides, please use the Contact Us section of the website at www.merkinvestments.com. Also, for future webinars, as Axel has already explained, if there is a topic that you're particularly interested in and would like us to cover, please let us know through the comments box. This concludes our call. Have a great day.